Welcome. Today, we are diving deep into one of the most powerful numbers in all of finance, earnings per share, or EPS. This is the number that makes headlines, the metric that can send a stock flying or crashing. We're going to break this down, not just as some dry formula, but as a real strategic tool, giving you that consultant's mindset to look right past the noise and really see what's going on with a company's financial health. I mean, it's the question, right? You see these huge numbers, billion-dollar revenues, massive net incomes, but they're so big they're almost abstract. What does that actually mean for an owner, for an individual shareholder? If you own one little piece of that company, how much of that giant profit pie actually belongs to your single share? Well, that is the exact powerful question that earnings per share was designed to answer. So here's how we're going to tackle this. First, we'll nail down what EPS actually is. Then we'll get our hands dirty with the calculation. After that, we'll get into the really crucial difference between basic and diluted EPS. From there, we'll connect it to stock prices, learn how to spot some red flags like a pro, and then wrap it all up with a toolkit you can start using right away.
Okay, let's get right into it. Before we can start analyzing anything, we have to define it. What exactly is this metric that Wall Street, investors, even CEOs are completely obsessed with every single quarter? Let's build our foundation. So this is the official definition. And you know what? It's the industry standard for a very good reason. It just cuts through all the complexity of a huge company's financial reports and boils profitability down to a single, easy-to-compare unit, one share of stock. This makes it the main way we measure how well management is actually doing its job, generating profit for the company's real owners, the shareholders. It's kind of the ultimate equalizer, letting you compare the profitability of a giant like Apple with a much smaller growing company on a level playing field. And this is just a brilliant way to think about it. Imagine a company's total profit, the money that's available to its shareholders, is one giant pizza. The number of shares out there is just how many slices you cut that pizza into. So EPS tells you exactly how big your slice is. Now, a higher EPS could mean one of two things. Either the whole pizza got bigger, meaning, hey, the company made more money, or the number of slices went down. And we're definitely going to come back to that because how the EPS grows is just as important as the fact that it's growing at all. All right, we've got the concept down. Now let's pop the hood and look at the mechanics. How do people actually calculate this number? It all comes down to a formula, and understanding the pieces of that formula is the key to spotting what's really going on. Conceptually, it's pretty simple. You take the total profit that belongs to the common shareholders, that's the top part of the fraction, and you divide it by the number of common shares, which is the bottom part. The actual formula is just a little more specific. We start with net income, right? The famous bottom line. But then we subtract something called preferred dividends. So why do we do that? Well, preferred stock is a different kind of ownership. Those shareholders are promised a fixed payment, so that money isn't really available to us, the common shareholders. What's left over gets divided by the weighted average number of shares. We use an average because companies are always issuing new stock or buying it back, so the number of shares changes all the time. Using an average just smooths out those bumps and gives us a much more accurate picture.
Let's make this real with an example. So let's say a company reports a net income of $100 million. Great, but it owes $23 million to its preferred stockholders. So that leaves $77 million as the profit pizza for the common shareholders. Now we look at the shares. Over the year, the weighted average works out to be 110 million shares. You just do this simple math, 77 million divided by 110 million, and you get a basic EPS of 70 cents. That's it. That is the number you're going to see in big, bold letters on every earnings report.
Okay, now this is where things get really interesting and where a sharp analyst can find a real edge. See, not all companies are built the same way. Some are simple, they just have common stock. But many others have what's called a complex capital structure. That means they have things like employee stock options or debt that can be converted into stock later on. This brings us to a super important distinction you have to understand: basic versus diluted EPS. This right here is absolutely key. Basic EPS, which we just calculated, gives you a snapshot based on the shares that exist today. Diluted EPS, on the other hand, asks a really powerful what-if question. What if every single one of those employee stock options were exercised right now? What if all that special debt was converted into stock? All those potential new shares get added to the bottom of the fraction. And since you're dividing the same amount of profit by a bigger number of shares, the diluted EPS is always going to be lower than the basic EPS. It's the more conservative, kind of worst-case scenario for your profit per slice. And this isn't just, a good idea. It's the rule. Regulators actually require companies with these potential new shares to report both numbers. It makes sure investors are getting the full, transparent picture. Think of it like this. Basic EPS tells you how things are today. Diluted EPS gives you a critical peek into the potential future and how much your ownership could get watered down. It's the forward-looking number that accounts for promises the company has already made. Okay, so we know what it is, how to calculate it, and the two critical flavors of it. But what's the bottom line? Why does Wall Street completely obsess over this number every quarter down to the very last penny? Let's connect the dots between EPS and what a company's stock is actually worth. The critical link here is something called the price-to-earnings ratio, or PE ratio. A stock's price is often just a multiple of its EPS. So if a company has an EPS of, say, $2 and the market thinks it's worth a PE multiple of 20, its stock might trade for around $40 a share. So when a company's EPS is consistently going up, it's sending a signal to the market that it's getting more and more profitable for each share. This makes investors willing to pay more for the stock, and that can create this powerful upward cycle for the stock price. And now, this is where we put on our consultant hats. A number is just a number until you put it in context. A rising EPS looks fantastic in a headline, but a smart analyst always asks how that number got there. The why behind the number is where you find the real story about a company's performance. Oh, the answer is a huge, emphatic yes. Look, managers know that investors love to see EPS go up. Their bonuses are often tied to it, and because of that, there are ways to make that number go up that don't actually have anything to do with the business getting better. This is where being a critical thinker is your most valuable tool. So let's focus on two major red flags. First up, share buybacks. Remember our pizza analogy? A buyback is when a company uses its cash to buy its own stock, which basically just reduces the number of slices. The pizza itself, the total profit, might not have gotten any bigger, but since you're dividing that same profit by fewer shares, boom, the EPS goes up automatically. Now, sometimes buybacks are a great idea, but they can also be used to hide the fact that profit growth is slowing down. You have to ask, is EPS rising because the business is on fire or just because the share count is shrinking? Second, you have to watch the gap between basic and diluted EPS. If that gap gets wider and wider over time, that's a huge warning sign. It's telling you that the number of potential new shares is growing faster than the profits are. It's a leading indicator that your slice of the pie is at risk of getting smaller in the future. All right, we have covered a ton of ground, from the absolute basics all the way to some pretty sophisticated analysis. So let's boil all of this down into a simple, powerful toolkit, a mental model you can use every single time you look at a company's earnings report. Here are your three big takeaways. Number one, EPS is your starting point, your ground zero for profitability. It's the great equalizer. Two, never ever look at basic EPS by itself. Always check it against diluted EPS. The difference between those two numbers tells a story about the future. And three, and this is the most important one, be a skeptic. Always ask why the EPS is moving. Is it real, sustainable growth, or is it some kind of financial engineering? That context is everything. At the end of the day, understanding earnings per share is about more than just a formula. It's about developing an owner's mindset. It's about having the framework to cut through all the noise, to ask the right questions, and to really understand the story the numbers are trying to tell you. You've got the tools now. The only question left is, what are you going to see that everyone else misses?